Hello and welcome to the Next 100 Days podcast. My name is Graham Arrowsmith.
And my name's Kevin Appleby. So, Graham, on the back of you doing the Alternative Investment Summit, we're talking to Agam Jain from Vector Capital this morning.
Yeah, I mean, Agam hopefully becomes a future guest on the next iteration of the Alternative Investment Summit. But today, Agam, a big warm welcome to the Next 100 Days podcast.
Thank you. Pleasure.
Well, you know, a Vector Capital is a PLC. So for those people who probably are not quite as versed in being a PLC as you are, tell us a little bit about what that has meant to you. What obligations does it place Vector Capital under?
Okay, so PLC just stands for Public Limited Company. And the way a company becomes a public company is that it goes through a process called an IPO. So at a particular time, it may have been a private company. It then feels it's got a good story. And then along with its advisors, it goes to various investors and city funds. It does a roadshow. It sells its story. And then investors say, some say, well, I like this. I want to be part of it. And then you have a day when all the shares are new shares are issued to new investors, and then those investors become a part of the company.
Yeah.
So we did that. So the company itself's been going for about many decades actually. But as a finance company, it's been doing it for about 25 years. And then in December 2020, we did the IPO and made 25% of our shares public. And so we're listed on the AIM section of the London Stock Exchange now. And so people can buy and sell our shares. Does that sort of answer your questions?
Oh, it does. I mean, the really nice thing is that Vector Capital PLC is actually one of those companies you can actually trade. We don't often get that, Kevin.
No, we don't. No. So the way you would invest in Vector Capital is go and buy some shares.
That's one of the ways. Okay. Now, the thing about a public company is it does an offering at the beginning, okay? And so the people that have bought the shares at that time can then, sell them, trade them, whatever. And other people can buy the shares that they've sold. So there can be a bit of trading on there. What a company also does is, and we've did that as well, is that we go back for a second round, for example, and then we issue some more shares to the public. So you can do that, but those events only happen every few years. But in the meantime, and we'll no doubt discuss this throughout the podcast, is that we have other ways people can get involved rather than wait for a new.
No, you just can't hold Kevin back, Agam. He just goes straight in there with a big question, and it's typical of a supporter of the top four football team. But anyway, we'll move away from that. The one thing about Vector Capital is that you say in a description of what you do, and this is quite interesting. You specialise in finance for land and property development, and so what was it that first got you interested in financing land and property? Because I know that you've been involved in it for a long time. So go back to that moment. What was it that got you into this arena?
Okay, look, I used to run a very successful technology company for a couple of decades, and we used to be generating really good profits every year. That the technology business didn't require. And so what you do is you end up putting it on deposit accounts and things like that. You get a bit of interest, and that's fine. And then there was a chap that wanted to start a travel company. I'm talking about 1999. And he said, look, Agam, it'd be great if you could give me a loan. And I said, yeah, but I don't know, what if you don't make a success of it, then what happens? I had a very good friend who was a land lawyer for Wimpy's at the time. And he said, look, what you can do is you can lend him the money and you can take a charge over the property. Okay. And so that's how the journey began, right? So we gave this chap a £25,000 loan, and we took a charge over the premises in Fulham Palace Road, I remember. And that's how
was that just one room? Because Presumably, these
No,
prices.
he put in his own money as well. You never
I
get
see.
100%.
Right. Okay.
Yeah. So he had some of his own money, but he wanted some more money
I see.
to get his business going. And and then we learned that the first charge that you take over a property gives you absolute security in that if the borrower defaults, you can take over the property and sell it and recover your money and then pay him the difference.
Yeah, so you can actually take the whole property.
That's it.
Of which you've probably identified that he's got at least 80%, I would imagine, of that of the equity technically.
Yeah.
But then you would have the right to actually sell the property, get your money back, and then pay him.
Very rarely does it come to that crunch.
No.
But that's how mortgage lending works. Okay.
So you stumbled into it, Agam, then.
Everything is stumbled into in life, isn't it?
Yeah, that's true.
There's a word I can't pronounce, serendipity, I think it is.
Yeah. You're close enough. We'll edit it in because we don't want to make a fool of you, do we?
No. Say it the way I said it. So everything's comes by chance and it starts. And then that was the beginning of a big journey. And then I found that we were attracting lots and lots of people through my accountant at the time. He started bringing lots of people I remember some people trying to develop properties in Bedford, this, that, and the other. And we'd learnt our ropes. We had a very good firm of solicitors who got all our paperwork done. And through the 2000s and,
so the tech company that effectively financed this venture, is that still going? Are you still interested?
Right. We listed that company on the Australian Stock Exchange, and then I exited with some more money out of it.
Yeah.
And then then in 2016, in 2016, then I exited and concentrated just on this business.
Right, yeah. I understand. Okay, so really from 2016 until now, which is 7 years or so, you've been focused quite heavily.
Yeah, that's it.
On Vector.
So one of the first things I did was I concentrated on building a software platform.
Right.
Because whenever you want to do any business properly, what you've got to do is make sure you get all your infrastructure, your processes all set in stone. And one of the things that I had learned is about software platforms in the previous technology business, because we'd installed, we were one of the first pioneering installers of Oracle's NetSuite in Europe at the time. This was in 2006. So I'd learned about how you can make an office operate completely paperlessly.
You're gonna get it's like Pavlov's dog.
Yeah.
I mean, Kevin's salivating. I mean, you're talking his language here. Isn't that right, Kevin?
You can't beat a good finance system, Graham. You cannot beat a good ERP finance system.
Well, reading your biography, you were kind of, that's one of the things that kind of gets you, doesn't it? It's that the ability to sort of comprehend these systems.
Yes. Do you know that people used to use things like Sage, Excel sheets? We used to use that to manage stock, and then you'd use a Word, and everything had come out at that time, and you could do quotations, and it was all very good, and it was the next step from what we had in the decade before. Yeah. But with NetSuite, what happened is you could do everything on a joined up system. So you could have your product list, your price, all your prices. You could have prices for wholesalers, you could have prices for retail customers. Everything was on a database. All your customer records were all on your database. You could then, just type the first few letters of the person that you wanted to send a quote to. It brought up his record. You could pick the products, pick the price range that was going to apply to them, and zap out quotations.
Wow.
The customer would accept. That would then become an order. Shipping would know what to send out. Invoice would get generated, all the accounts ledgers get updated, statements are sent out to the customers. So you can see it's an all joined up process. I mean, now most companies have something like this, okay? About 10, 20 years ago, it was still quite new stuff.
It's amazing. I don't know, Kevin, I mean, in your experience dealing with lots of finance directors. You echo that, don't you?
Oh, absolutely. And we're talking now sort of 20 years down the road. As Agam says, most companies have got a system like that. But the thing that's on everybody's agenda now is automating other parts of the process. Making sure all your systems talk to each other, that you're not relying on manually transferring numbers from one system to another, making it very, very easy for people at the front line in Salesforce to submit things on mobile devices and integrate everything across the business.
One of the other comments I've got on this now. So when I started asking us developers to write this platform, I thought, let's cover all angles. But then I also decided we have to take a step back. So we'd made a customer portal, so you could just go onto a website, fill out your requirements, and you get a quote back, and you could virtually do everything that way. We could even start thinking about, well, shall we start using AI for underwriting? Okay, but then I thought, we're not that far down the line yet. The customers are not ready. We're not ready. Okay. Yeah. And so, in fact, we stopped using our portal. Okay. Because what we realized that one of the USPs that we've got over the big banks is that people like to be able to talk to somebody. Yeah. So whenever we get an inquiry from a broker or somebody that wants to develop a property, what they want is to have a few minutes with somebody on the phone where they can explain what it is that they're trying to do. And then the other person gets it and says, look, yes, this is what's possible. No, you can't do it this way. This is what you can do. And then, after 5 minutes, both people know that we can help each other. Yeah. And then we can zap out the quote, the offer to them. Okay. So rather than get them to struggle on some online platform trying to do that. Okay. Yeah. And similarly, the reason we're not going down the AI route right now, okay, because we're lending sort of fairly substantial amounts of money. Average loan size is maybe £500,000 or £600,000 hit. Some loans are like £3 or £4 million. Yeah. And no company wants to think I've relied on AI.
No. It's
to make that decision. Right?
When AI comes along and there's a little robot sat here on the next 100 days for Vector Capital, and they've shifted you to one side, Agam, then basically that's when they'll probably do it. And I agree completely with your strategy. So many elements of the human connection, the emotional connection, which actually bonds people to companies, even finance companies, then basically I think that's a brilliant strategy. And it's obvious as well. Use AI perhaps where you can, but don't make it central. Not yet, anyway. I don't know about you, Kevin. Do you know anybody doing that?
I see AI at the moment as a research assistant.
Yeah, I guess
you can go into the one that I use. I'm using two platforms at the moment, sort of comparing, contrasting between each. There's ChatGPT and there's a marketing AI called Jasper. And now I'm asking questions. I'm getting things out of it. And we were amazed a couple of weeks ago. We were running a boot camp, finance transformation boot camp. We needed a case study. We put in the sort of parameters of what we needed the case study to do. And ChatGPT produced the case study pretty much with us needing to do very little to tweak it to get it to exactly what we wanted. So I see AI as a research assistant.
Or even a validation tool, because we've put a few bits through ChatGPT, like you said, and it's very good. Okay. But maybe because of my generation or whatever.
I don't think so. I was talking to another client the other day, and the one thing that strikes me about her business is that it's so personal. And I think I might be in a market that's dealing with people who want to have that personal touch. But having said that, it seems to me that that's where the bonds are going to be made, and that's where the difference between you and other people is going to happen. But the thing about Vector Capital is that as I mentioned, you finance land and property. they're kind of different, aren't they? So land is one thing, property is a different thing. Where does most of your loans go into? Is it land or property?
Okay, so it goes into property, but so let me just tell you what the difference is. There isn't that much. You have some investor that thinks, look, okay, there's a piece of land available for sale. It hasn't got planning permission at the moment, so then it has a certain value. So they might want to buy that, and then they'll be able to maybe get planning permission, or they won't. They'll try that. The value then will go up. Okay.
Sure.
The third stage is then they may tie up with a contractor and actually build it out. Okay, so that's 3 stages that you can have with land. And then there's the traditional bridging, which is somebody sees an investment property, they think it's a good value, maybe at an auction, and they want to buy it and they want to be able to move quickly. Okay, and that's where bridging comes in, because if you went to a high street bank and you wanted to buy a piece of land, first of all, nobody would talk to you anyway, okay? And you just won't tick any of the boxes. So land is something that none of the high street banks will do. Okay, so you'd usually go to a bridging company, and a bridging company with a human at the other end that can then see, well, okay. And the way we work is we get an independent valuation. There's a Royal Institute of Chartered Surveyor, and they have lots of members who work to a particular code, a red book. And then you would get them to go and you would commission them to do a valuation for you, the lender.
Right.
Okay? And they would say, well, what we think is that this land is worth this much because of this, and they would justify how they got to that value. They usually do it by looking at other transactions that have taken place for similar sizes of land in that region. So, and then they give you like a 30, 40 page report of how they've arrived at that value. And we normally ask for 4 types of values. So we'd ask for a valuation that if we had to sell this piece of land, and this applies, by the way, across the board to properties as well, land or property, and we give ourselves 6 months to sell it, i.e. we went through the normal marketing channels. What would the value be? So that's called 180-day value. Okay. Then there's a situation where we think, well, if we had to go to auction on this because we just wanted to get rid of it, and we didn't think that hanging around would help. So that's called a 90-day value. Okay. Then we also ask for a value that if we decided to hold on to this property and we wanted to rent it out, what's the rental income we could expect? And then a 4th value we ask is a reinstatement value, which is if there was a fire and it got burnt down, what would it cost to rebuild it? Okay, because throughout the period of the loan, we have to make sure the property is insured, because the last thing you want if something happens, that you're not then covered as the lender for that. And all the things that I'm saying to you is nothing that I've created. This is what all the mortgage lending industry, that's the sort of procedure that they follow.
But you've managed to build a pretty healthy loan book, which is, I guess, it's just a ledger with people that have got loans from you. So effectively, if you add them all up, it comes to
the live ones as of today.
So it'll change in and out, sort of thing. So basically, as I understand it, that's over 50 million, which is quite an amount of money that you've loaned.
It is. I mean, obviously, we're nothing to the size of NatWest, HSBC, but people can talk to us directly.
But unlike NatWest, though, Agam, you're probably not going to bar somebody because they voted for Brexit. So basically, no. I mean, but you from your point of view, you effectively you've got this loan book, which, as you said, the average order. I mean, that's quite a number of loans, isn't it, that you're managing at any one time? Yeah,
as of today, it's about 103. Because every chief executive is always going around with 4 or 5 key figures in his head every day, and they're the ones that he's monitoring, isn't he? Right. So, what's your loan book today? What's your revenue figure? What's the number of live loans? What are your defaults? There's a set of figures. That's all you breathe and sleep every day.
We've heard this before, haven't we, Kevin? This idea that you have to have certain metrics about your business live in your head.
Oh, absolutely. And I think if you really think about it, you can concentrate it down to one metric. Way back when Lord King was turning British Airways around, he wanted to know about one metric,
Right.
and that was planes that were late departing.
Yeah.
And if he found a plane that was significantly late departing, somebody became very, very accountable on the other end of a telephone call.
Mm.
Things changed very rapidly.
Different order of magnitude. I think he probably had so many buttons, so many spinning plates that he had to choose one that was going to be quite important. And I get that, and it's a real. You mentioned that before, Kevin. I've got to say you've got a very good memory. But one of the things that I wanted to pick up with yourself is, and Kevin hinted at this right at the beginning. You attract investors because you're making them certain offers. So yes, people can come to you and get loans, but investors can come to Vector Capital without owning any of your stock, and they can actually profit from the relationship with you. So do you want to sort of take us through one or two of those things that you offer investors? Because that's quite interesting.
Yeah, okay. So in order to just set a bit of the background, so we've got quite a substantial shareholders' money that is the company's own money. So
yes.
We've got around 30 million of that. Yeah.
Right.
And then we've got very large bank facilities as well. So we've got certain wholesale banks that will give us money. I was going to use the word at a good rate, but it's not very nowadays. So we've got about 45 million of facilities that we can draw down on.
Right. Okay.
Now, what we also like is to have investors sort of participate with us on the journey. It just makes the business more interesting. So we offer 3 ways investors can get involved. So there's a straightforward loan note, it's called. A loan note is simply where an investor gives you a loan and then we pay them interest against it. Yeah. Now, this isn't available to everybody. It's only available to sophisticated and high net worths to meet with the regulations. The other thing is a lot of people want a bit of excitement as well, and they want to actually get involved in a deal. So I call that a co-funding model, and I'll talk a little bit more in detail about that because that's probably something of interest to your audience. Yeah. So it's so say there's somebody he's bought a block of flats, he's paid £2 million for them, okay, and then he's come to us and he said, can you help us finance that? And we'll say, all right, we'll give you 75% loan to value. So we'll give them, say, £1.5 million, and we'll take a first charge over the block of flats. So the borrower is now sorted out. And so we've got a loan on our books for £1.5 million. Right. Now, we can then put that out through a guest login on our website, okay? Or if you're on our email list or something, and we can say, look, this deal's available. We've funded it ourselves. But if anybody wants to participate in it, okay, then you can come in. For as small or as large an amount that you want, okay? So we've already funded it, so we're in for 1.5, okay? We may be charging, say, the borrower, say, 12%, okay? And so what we'll say is that if you want to come in, say, for 500,000, okay? So that means, let me make it a bit simpler on the figures. Let's say we've lent out £1 million, okay? Yeah. And then somebody wants to come in and say 400,000, yeah? And so that means we're saying to you that you'll get 40% of share of the security, okay? Right. And we will pay you an interest. Probably say if we're charging the customer 12, we'd probably give you 10%, and we'll take 2% margin to cover our administration and finding the customer and managing him. Yeah. Now, what we do to give you the co-funders total security is that first charge that we've got, we put it into a trust, okay, which the beneficiaries are Vector and the investor, okay? Yeah. So it's very simple procedure. And that means if the worst ever happened, which God forbid it never does and it never will, okay? But if it did, then what happens is that the property gets sold. Yeah. Yeah. What the proceeds that you get from the sale are shared 60-40 with the co-funder.
Right.
Yeah. Was that straightforward?
No, it's perfectly straightforward. And actually, it's really reassuring, Kevin, because in effect, what you say, somebody can come in after you've done the deal.
Yeah.
You said at 1.5 million, let's call it 1 million. And so you've done the deal and they come along and say, well, I'll put 400,000 in and I'm going to get 10%, which, you'll presumably pay them back periodically. And the end of the, or is it, hold on a minute, is it, let me get that clear. So basically it's a million loaned and then 400,000 from an investor who might well get 10%. When does he get the 400,000 plus the 10% back, or does he get the 10% in chunks back?
So the normal type of deals that we do is monthly payments. Yeah.
Right. Okay.
So our borrower would be paying us interest once a month.
Yeah.
Okay. And we would be paying the co-funder once a month. Okay. Now, sometimes, especially when you're developing a site where you're actually doing some construction, what the borrower asks, can I please have it rolled up? Okay. So that because I haven't got any money coming in till the building is complete and I'm able to sell it. Okay. So what we would say is, all right, instead of charging you 12%, we're going to charge you, say, 14%.
Yeah.
Because we know we're not getting any money from you till the end. And then when he has completed his project, he doesn't even wait till he's sold it. He can refinance with a high street bank at that point. Because once the building is complete, he can then go to a high street bank and probably borrow at a much cheaper rate than what he was paying us for the bridging. Okay.
Right.
So at that point, he gets refinanced from another bank, and then that money is used to pay us back and the co-funder simultaneously, along with the rolled up interest. So that's one end of the scale, but normally it's monthly interest.
I see. That's really interesting. So basically, the sort of mainstream lenders come in once the risk's been largely taken out. And so therefore they might come in, approximately, we've talked about rates there. Where would they normally come in at? So 8%, 7%, 10%?
Just to give you some more justification of that. So what happens is, say you're building 3 houses, okay? And you may decide you don't actually want to sell them, okay? And you want to rent them out. As soon as you got them, you've issued your ASTs and you've got some tenants in there, and you've got some rental income, you can then straight away go to a bank and get a BTL mortgage. Now, BTL mortgages, if you ask me what they were last year, you probably get them for 3 or 4% last year. Now they're hovering around 7 to 9%.
That's a buy-to-let mortgage. So basically, you're actually it's a renter's mortgage, or okay.
So that money would then be used to pay off a bridge lender like us, who's charging them, 14% at that time.
So it's not quite, but almost double. So basically, from that point of view, all right. So he can manage it at that point, as long as you're getting the rent in at the right level.
So that's. But usually they've done all those calculations when they start their projects. So for a builder right now, the problem he'll have is all his cost of materials are going to go up, but he can charge higher rents.
I've been listening to all kinds of things recently, and one of them is that interest rates probably going to start maybe leveling, and certainly inflation is going to come down. That probably the government will probably want to bring down interest rates certainly prior to an election next year. So basically, from that point of view, there's a reasonable sort of midterm expectation that rates are going to come down. Is that your estimation as well, Agam?
Every time I crystal ball gaze,
we're allowed to, because we're always wrong.
I'm right on the day, but a month later, the goalposts change. Right.
No, well, that's true.
Earlier on in the year, I'd gone to this a NatWest seminar, economic seminar, and everybody was of the view that interest rates would peak by the summer.
Right.
And by summer, not July, they meant June. Okay. And then after that, Q4 of this year, you probably might even start seeing the first reduction. And we thought, all right, so let's just ride it out for the next few months and everything will be all right after that. Okay. Then it's gone on to a rate rise we've just had recently, and inflation figures have come down. So that gives us a bit of hope. But then I'm hearing all these articles coming out in the financial press about we might be on this level for 3 years and this and that, so it's very difficult to predict. Okay?
No, okay. Well,
I'm hoping that by Q1 next year, maybe 0.25% down or something, but that really is crystal ball gazing. Nobody knows. Okay.
No, okay. Well, we won't quote you on that, will we, Kevin?
No, we won't. So, Agam, when you're giving a loan, it has an interest rate with it. Is that interest rate generally fixed for the length of the loan, or is it
in our company, the ones
variable according to the base rate?
Yeah, they're all fixed.
Yeah.
We don't even relate them to the base rate, so we fix it, and we give a fixed term as well. So we'll give you 12 months fixed rate. Okay. Now, if month 11 you're finding you're not going to be able to pay it, and you're going to come back to us for an extension, at that point we have the option to say to you, well, yes, all right, we'll extend it, but the rate will change.
Yeah.
Okay. So, but we often find let me tell you this: over the last 20 years, we've hardly had any rate changes.
Yeah. True.
Yeah. At least in the last 10, 15, if I go by memory, it's just been the same. So the scenario we're in is quite different to what we've all experienced. So when people came to ask for us for an extension, we just rolled it over. Okay. Although in our small print, we had that facility that we have the right to charge you at a different rate. And if you don't want to accept it, fine, then just pay us back. Okay. Now, we're still sort of culturally working like that. We don't want to charge an existing borrower more. And wherever we can absorb it, we absorb it. But we keep the option to do so.
I know you say your rates don't necessarily reflect the base rate, but you did say that so much percentage of your, shall we say, facility, and that will be governed by the base rate, surely. I mean, so effectively, if your facility, unless you've got a fixed facility, presumably, which comes in at a certain percentage forever, which I doubt. So basically, the whole idea of it up to a point, it's governed a little bit, not necessarily, only in part.
All right. You see, a lot of things should follow that pattern. But what determines what we can charge is what other lenders are charging out in the market.
Right. Right.
So bridging rates have traditionally been 12% a year, and we used to charge 11. Okay.
Yeah. Right.
Now they're creeping up to 13.5, 14. And so we're probably trying to achieve 12 and a bit now. Okay. Yeah. Now, when it's a construction project, then it's a bit more. Yeah. And when you do a second charge loan, then the rates are even higher. Yeah. Yeah. So that's one factor. So everything in the end is connected to base rate, but not necessarily a straight line connection.
No.
And then our bank facilities, okay, didn't used to be connected. Now what they're trying to do is they're trying to get us onto SONIA rate. SONIA is the new SONIA plus a percentage is the way they charge, and that replaced the LIBOR. Right. Which used to be the interbank lending rate a few years ago.
Okay, all right. Well, we'll put a link to Sonia so we can. There's an explanation there for anybody who's really gagging for that. So if I understand this right, as a summary, where we've got to, you Vector Capital PLC effectively specialise in finance for land and property, but you do these loan notes, you do these co-invest or co-funding, and then basically you've got a third level, I believe. Tell us more about the other thing that you can offer.
Right. The other thing is a small percentage of loans do go bad.
Yeah.
Okay. And that's part of the nature of the business. So the way a company judges itself is what profit it manages to deliver at the end of the year. Okay. And getting 9 things out of 10 right, and being able to absorb the 1 out of 10 that go bad. Yeah. Okay.
Yeah, sure.
And that's how all lenders work. Okay. Yeah. So similarly with us, we have a few loans that go bad. Okay. Mm-hmm. We try and help out our borrower as much as we can by giving them time. We give them the chance to try and sell it themselves. Sure. Okay. If none of that is getting anywhere, then we step in and we appoint a receiver who is there to try and dispose of the property. Now, when we're at that stage, we are in a position to say to people that are are sort of in our network, look, these properties are coming up available, and you can, if you're fast and you can move, quickly, you can make an offer, and would likely ask the receiver to accept it. Yeah. So, in as many words, basically, you can buy properties at a good price.
Right. So the people most interested in that would be, well, I mean, there could be all kinds of investors. There could be the high net worth and sophisticated investors, but they would need to see a route to take it. I've got the money to buy that asset, Agam, but basically then what do I do with it? Because, it's just a distressed property asset.
Right. Well, that's a very wide question, and I'll give you some answers. Because there are certain people who just buy property, change the locks, board up the windows. I hope there aren't many of them, but there are some like that. And just wait for 5 or 10 years for the price to appreciate.
I see. Okay, fair enough.
Let's sell them.
Right. Okay.
There'll be others that will buy them, go and give it a quick lick of paint, and try and rent it out ASAP.
Right.
Okay. Yeah. In the past, there might have been people that might try and flip the property straight away. I don't think that makes sense now with the stamp duty rates and new prices aren't going to go up. So, but there are also people trying to build up a property portfolio, taking a long-term view that, all right, we'll do both. We'll buy the property, we'll try and rent it out, we'll hold on to it, okay? And then over the years, they've just built up their portfolio. So there's a lot of types of property investors. Basically, as with everything, if they can buy cheap, they get a better return than if they go and buy at market prices. Yeah,
we've come across that before, Agam. We had Wakas Khan who was on not too long ago, and Wakas runs a business in the sort of property development sphere, and he was actually on the Alternative Investment Summit. But basically, one of the things that he does is he takes distressed properties and then with his own development company basically turns them into, well, mini palaces. I've literally seen one with my own eyes, and it's just amazing the transformation you can get, but particular, quality transformation. So there are people out there that do this sort of thing in a really professional way, and I think from memory, I think he was saying that most of the profit really comes at that front end. So if you can buy well, then you're baking in a real solid return that you can actually, factor into your investment.
The other thing that we can also add to the mix is the fact that we can also then provide a mortgage to the buyer.
Ah, right.
Should they need it?
Yes.
And are prepared to pay our rates. But if they're well-heeled and they've got a good relationship with their own bank, if they can get a good mortgage from them, great. If they've got cash, even better. But if they need us, they can use us temporarily, to do the deal, and then they can look for refinance afterwards. Basically, bridging, as the word indicates, is to use a lender like us to get a deal done. Knowing that you're paying a slight premium. Okay, but you can get your deal done, and then you can take your time and look for the best exit route for finance afterwards. Okay, because a normal bank will sort of drive you around the houses for at least 3 to 4 months.
Right. Right. So if I understand you right, Agam, if you have a number of these properties available for high net worth investment, these, I want to call them distressed properties, but you use
I don't like using that word because what we've been as generous and as helpful as we can to the borrower. Their affairs sorted. And when it gets to the point where a receiver is appointed, they also know that is the only best option for everybody. So
how would you describe that particular scenario?
I just call them available properties. Right?
Available. Okay. Oh, you've been fat. So what? They're all available. But no. Okay. But okay. But all right. So basically,
because any other word that you use doesn't sound nice. Yeah.
No, I get that. But at the end of the day, you
call them repossessed properties.
Repossessed properties, and I think that's not unreasonable to call it that, because that's exactly what it is. But it's those are within your purview. You know of those have come about because of the relationships you've got. It's not like there's a stream of brokers who say, I've got that thing, I'll just take it to Agam. Or is there? Do you find other people? No, so it's basically the ones.
We're only dealing with our ones.
Yes.
Yeah. We're not in fact dealing with them. We're just making them available
Yeah.
to them because we've repossessed them.
Yes.
And then we have a full history on them. Because remember, we've got that 30 to 60 page valuation report on them with all the details.
Yeah.
We know exact the circumstances. So we can give you all of that information so you can make a considered judgment.
You can imagine, Kevin, that if you're an investor, what kind of person would you really like to deal with? Somebody who's got that 30-page report, who cares about actually getting to know you, who's open and transparent, and has got honesty baked into the company. And all you have to do is look at Vector Capital's, documents, and you mandate yourself to be an honest and and to have integrity. And it's really important as an investor to trust the person that you're dealing with.
Yeah, and let's face it, Graham. You go into an area of the world that there is some risk. Mm-hmm. You're looking at folk that are buying properties, redeveloping properties, selling them on, need the bridging finance to get in there. Now, there are many reasons why something might fail, and it's not necessarily because of the property itself. So I'm looking at that scenario where Agam might have repossessed property for sale. Doesn't mean that there's necessarily anything wrong with the property. The person that previously took the finance on that property had a problem. So, I'm seeing some very interesting things to look at here. And just in general, understanding how that world of bridging works has been fascinating. And I'd never looked at this area in detail. I know bridging many, many years ago would have been something you'd go to a high street bank for. But we all know that banks aren't interested in taking any sort of risk. Banks don't loan you money unless you can prove you don't actually need to borrow it.
Well, I went through it, Kevin. I mean, I was moving from Derbyshire back up into West Yorkshire, and Royal Mail, who was my employer at the time, had to bridge me. Well, it cost them a small fortune, and that was with a mainstream bank. I won't mention who it was, Lloyd's Bank, but basically, at the end of the day, I didn't mention that, did I? Oh, all right, sure, fair idea. But the point is, they actually, and I was quite happy that they did, because they were my bank at the time, and basically, I've got to say that it helped us out of a pickle. But the thing about bridging is, it's almost like it's a gift to the developer. If in the case where it's not only are you offering them the loan, but you're giving them almost like a backstop that says, look, if it doesn't go right, we have the opportunity of making it right. Are there any of your loans that don't perform, that then you go into this sort of period where you're actually offering these repossessed properties that just you can't do anything with? Or do they all get resolved?
Right. Let's say from 1999 to now, we've never had a situation that hasn't got resolved. Okay, so everything does get resolved, and all our accounts, by the way, are public. So you can go either on the stock exchange website, type in Vector Capital, and download them all, or you can just go onto the Vector Capital website and you can download them, and you will see that we've got a very good bad debt record. Okay, in sort of revenues running into millions, maybe 30, 40,000 in a bad year. It literally is that bad. That good, yeah.
That is good. So basically, what do you really, when you get round the boardroom and your co-directors are saying, why are we so good at this? What do you answer?
The reason is because we're not doing unsecured lending. Okay, so we've always got the property there. Yeah. Now, where we might lose money is that when we come to sell the property, we've taken too long in trying to help the borrower out. Right. And in the meantime, interest has been accruing, and then that added to the capital exceeds the value of the property, right. And so you don't recover it. And a lot of times that happens is because the borrower is saying, no, look, I'm about to do this and this will sort it out. I'm about to get this from somebody else, and then I can use that to pay you back. And so that drags matters for a few months. Yeah. And then when none of the other hopes that he had work out, and we've lost 6 months.
Yeah.
That's usually the reason why you end up taking a small hit sometimes. But look, it's part of business, and we don't cry about it. Look, and the important thing is that with every business, you get it right more than you get it wrong. Okay, you'll never get it 100% right, and that's where the track record is.
And you're dealing with people, and people are strange beings, and you can tell that just looking at Kevin and me. So, I mean, at the end of the day, we are quite.
Don't get much stranger than us, Graham.
No, I suspect not. But Agam's probably got this sort of 30-page document about us both, and thinking
I haven't actually. But
would I lend to those two? No, not at all. No. But basically, I genuinely, Agam, you've made this world of property finance very relatable on this podcast. I'm really impressed by not only your passion, but your honesty, and it comes across that way. And I think any investor who's looking at a place to put their money could search them out, because I think it's something that won't go away. You're not going away, and Vector Capital is going to be there. So even if you're watching this podcast, I mean, Kevin, the we've been going for 8 years or so. It could be in about another 8 years. Vector Capital will still be there. So search them out.
That's the thing about this whole area. This is something, as Agam says, they've been going for 20 plus years.
Yeah,
haven't been a PLC for quite that long, but the fact you're dealing with a PLC gives you some idea of the longevity, the security, and so on that's available.
Just another word about PLCs and why they're different from private companies. By statute, or should I say by rules of the stock exchange, you have to have a certain number of board members, okay, that are, we call them non-executive directors, they're called, okay, and they're there to sit on your board and scrutinize everything that is done, and without them voting for it, no company decision can be done. So all your board meetings have to be minuted. The non-executive directors have to make sure that this is not going to put the company at risk, that all the shareholders are being protected, that you're following all the rules, the company law requirements, as well as the stock exchange requirements. So that's quite a good discipline. And I welcome that, just even if it wasn't because of being a listed company. It just means that you're running a company properly.
It keeps you on a train track, though, doesn't it? I mean, you still have some decisions to make about the destination you're going to go for, and the way in which you're going to get there, the kind of carriage that's going along the track. There are things that are within your gift, but there are other things that keep you on the straight and narrow.
And everything that I do as a CEO, or obviously I've got other people with me. I've got a CFO. I've got operations director and all that. And then the non-executive is the actual chairperson. So all of them have to be carried on board for everything significant that you do. So even in our case, I'm allowed to authorize a loan up to 750,000 from within the management team. But anything beyond that needs a full board approval. Okay. So that's the level of checking that and scrutiny that's done, not just for us, but for all public companies. The other thing that a public company has to do, it has to have a very expensive and heavy audit. Okay. So we can't just go to somebody like a high street accountant to look and audit our account. It's a very, very heavy audit. And that's probably one of our biggest costs, because you've heard of all the things that have gone on, and all auditors are now scared of their own shadows, and they charge huge fees. And they don't want to touch you if they feel that there's any risk to their reputation. No, indeed. And so they come in and do it thoroughly. And then also, I was mentioning that we have wholesale bank facilities. And what Kevin said is absolutely true. Banks only lend you money when you don't need it. And that's why we've got a lot of facilities that we don't actually fully utilize. Okay. They come and audit us. So 2 banks auditing you every 3 months. Okay, so that's 8 audits, and they want to come in, they want to interrogate every transaction, they want to keep talking to you, because they're so scared of everything, banks. Okay, right? It's So the level of auditing and double checking everything that we do is just incredible. So that is one of the big differences between a private company and a public company.
Wow, it's been an eye opener, and Agam Jain, I want to thank you for being on the Next 100 Days podcast.
So, Graham, I must admit, I found that fascinating. You know? In my world of CFOs, so we're frequently talking about fundraising, but it's fundraising of that type that Agam mentioned in creating a PLC. It's the IPO, or it's getting the investor on board for your company that you might be going through various rounds of raising finance as you're growing a business. Never have I delved into the world of bridging.
No,
didn't understand how it worked. No idea. So I think really, really interested to understand what Agam's company is about. And then from an investor's point of view, I think Agam told us some great stuff about the extra security you've got around dealing with a PLC.
It's already there for you, isn't it? And the whole point is they've got the first charge on this property that they've organised, and hopefully you get dealt in on some of these opportunities. And if you've got a bit of spare cash that you don't mind putting out for a little while, then basically you're getting 10% per annum back on it, or even more. Then nice. It's very nice. So basically, why A, you're ahead of inflation, but B, you've got the security. Now, ultimately, there are probably some scenarios where everything could go, a bit ropey. But at the end of the day, it doesn't seem to be happening that way, even in a tough market.
No, quite. And as I said, when we were recording, there are going to be many reasons why a property might become distressed. That's nothing to do with the property itself.
No, I don't think any property developer probably starts off with it's all going to go Pete Tong, and at the end of the day, they have to. Sometimes circumstances get in the way, so and the due diligence that Vector will take will probably eliminate the sort of ne'er-do-wells. It won't take everybody. So at the end of the day, if it's gone wrong, then there are probably good reasons. And you can see that their Achilles heel is very much when they become human with another human and grant them a little bit more time to rectify things. So, short of them becoming more hard with people, it's one of those awkward ones, isn't it? Do you do that or not? I don't know.
Yeah. But fascinating, Graham. Fascinating.
Absolutely. Another a fascinating podcast, as Kevin says, with Agam Jain from Vector Capital PLC. Well, today I've been Graham Arrowsmith.
I've been Kevin Appleby. Goodbye.
Goodbye.